going to come up here. So I'm not just going to hide the figures.
Yeah.
But Capitec so far has got a gain of about 4.73%. That's me. That's me.
So bravo on that.
Discovery, 4.54% to the green. Well done. Shoprite.
I want you to emphasize on that.
Shoprite Holdings. Shoprite Holdings. It's our star performer.
Yeah.
It's on a roll.
Welcome to the 5th episode of the Investment Candle.
Yes.
Again, my name is Chifiwa. I'm still here. I am the co-host of the Investment Candle podcast.
Yep.
I am not a guest. I feel like it's always important that I actually clarify that. I'm not a guest, guys. I am actually a co-host.
Yeah.
And again, I'm not alone, as always. I'm with the tech guy. How you doing, brother?
I'm well, man. I'm well.
I see you rocked your Arsenal jersey today.
Of course. In fact, quick anecdote just to get us started.
Yeah.
At work, whenever I wear something sporty, they know that the Investment Candle podcast episode is going to be recorded. So,
it's quite ironic that we're talking about investments and yet we actually wearing sporty things, because I've got my Bokeh jersey here.
Exactly.
And you've got your Arsenal thing.
I've got my Arsenal. Jersey.
How much was the pain when Arsenal didn't win the league?
No, man. Listen. I think it as painful as it was.
Yeah.
It's not as painful as losing money, which currently my investments are not doing. But we're gonna get there in the portfolio check.
Fair enough.
Yeah. You? What inspired the
Bokeh jersey? Yeah. Actually, at work they're doing this thing of because the Rugby World Cup is coming up.
Yeah.
So they're doing this thing of on Fridays. Let's put on our Bokeh jerseys. Fantastic. And support the team, man.
Another thing as well, the netball team.
Yes,
the World Cup is coming up. So
it's being hosted here in Cape Town as well.
It's been hosted here in Cape Town. So all the best, South Africa. Hopefully we win.
I hope so. I really hope so. But let's get into it, man.
Let's do it.
I think the first thing first, as you know, first and foremost, I think I would like to give our subscribers a name. Right?
Okay.
I came up with the name. It's a very common name because it feels like we're not connecting with them when we say subscribers, followers, all those things, right? So if we actually give them the name, so
wait,
let me know what we think.
Before I don't know what he's about to say. I have no idea. I'm waiting in bated breath as much as you are waiting.
I want your buy-in on this. Even you guys on the comments.
Let's hear this.
So I wanted to call everyone that follows us and subscribe to our content an investor.
An investor.
Yes.
I like it.
So you game?
I like it. Investors.
Yeah. Yes, investors. So thank you very much, investors, for subscribing and actually liking our content and sharing. But nonetheless, I think let's start. How's it going on our portfolio? And by all means, I'm giving you a chance to read it out loud, man.
So a portfolio check. Thank you so much also for the buy-in for the portfolio check. Doing quite well. This is how it looks like at the moment. It doesn't look good for me. For Chifiwa, it looks very, very good. So, and also don't worry, like it's going to come up here. So I'm not just going to hide the figures.
Yeah.
But Capitec so far has got a gain of about 4.73%. That's me. That's me.
So bravo on that.
Discovery, 4.54% to the green. Well done. Shoprite.
I want you to emphasize on that.
Shoprite Holdings. Shoprite Holdings. It's our star performer. It's on a roll, man. 7.72% in the green.
That's massive.
Since he purchased, since he's invested in Shoprite. Well done on your investment.
Yeah, and then let's talk about the last one.
And then the last one, I actually want to get into it because it's been quite topical, and also in our reel, people have been asking me about it. You know, we live and die about these decisions.
Yeah.
So Naspers is still in the red by 4.84%. So we've lost a whopping R6.40. rand on our portfolio. But
Yeah.
overall, our portfolio is up. It's doing well. It's nearly by 20 rand. Which is absolutely fantastic. Yeah, it's good.
It's very good. I mean,
stuff.
20 rand out of 500 that we put in.
Yeah.
It's good return, eh?
It's good return. So far, we're close to inflation. We're knocking on the door of inflation, and so far it's been 2 weeks. So far so good. If Naspers got it right,
comes to the party,
and eventually it will. I think we'll speak a little bit about Naspers. That's when we will.
Yeah, I think we might as well just get started on touching on them, right? In terms of what's happening in the portfolio.
Yeah.
What are you thinking around your companies? What are the key things that you've thought about, etc.?
Yeah. I'm not going to repeat what I said in the third episode 3. Please check it out. That's where I went into my investment rationale as to initially why I got in. But I wanted to speak about some topical issues. And I think this is why at the moment it's in the red. Because the market is feeling a little bit jittery, skittish. What's a more simpler term? They're a little bit unsure as to what's happening. And that's over the ownership structure of Naspers at the moment.
Okay.
So how it works is that, think about it, on top, the main holding company is Naspers, which is headquartered in Foreshore, not about a 10-minute drive from here, in Foreshore.
Oh, really? Headquarters of Naspers is in Cape Town?
Yeah, it's in Cape Town. It's in Cape Town, Foreshore, and it's been there.
For some reason, I always thought it was in Joburg.
No, it's actually here in Cape Town. It's in Cape Town. It's in Foreshore. So they own 73% of the big subsidiary, which in itself is not headquartered in South Africa, but then it's headquartered in Amsterdam. It's actually listed in Amsterdam.
But it does have secondary listing in South Africa.
It does have secondary listing in South Africa. So those who are keen on actually getting exposure to Naspers international assets, that is the way to go. Is through Process, and they own about 73% of that. Now, where the confusion lies is that these two companies, although they have a parent subsidiary relationship because of the control, they cross-hold each other shares.
Yeah.
So meaning that Naspers obviously owns 72% of Process, and then Process in itself owns a large, not a controlling stake, but a large, significant stake in Naspers itself. So they're holding each other. And that's causing a little bit of confusion in the market. In fact, those who are some Naspers shareholders, I think that's also something that you are a little bit unsure about.
Yeah.
So that's the first part. It's the cross-holding structure, and they want to actually simplify that. The second part of which the market is feeling very, very skittish about, but it's most likely going to remedy what we're currently seeing, is they call it the open-ended share buyback.
Yeah.
So basically, a share buyback is when a company feels that the share price is being undervalued. They themselves will purchase those shares back. And when they purchase those shares back, it should create a recovery of the share price. And how they're doing it? They're doing it through the selling of the stake in China, which is Tencent. They're selling a piece of that, and with that money, they are using it to buy back their shares. Very complicated, but we can get into it. I'm hoping there's going to be questions on it. Because I'm a shareholder, I make it a purpose of mine to actually know about this. But those are the issues, sticking points, and should those issues be sorted out, I'm convinced that you're going to have a better performance of Naspers.
Yeah,
that is the long and short of what's topical at the moment with the Naspers. As far as the portfolios are concerned, revenue was up. Profitability, not so much. But revenue is a good thing, because that's, in essence, like some of these companies are technology companies. And they have that J-curve thing about them, in that they are going to burn a lot of cash before they get into profitability.
Before they make money.
That's the long and short of Naspers, my man.
Yeah. No, I mean, you sound very convinced about the bounce back of Naspers. I mean, look, I'm not opposed to that as well. I think there's a lot of value unlocked that can still come out of a Naspers.
Yeah.
But look, it's whether or not management are going to achieve that, that's a question for you to answer.
It is. And I'll answer it. Yeah.
But from my company's perspective, there isn't much that is happening.
Yeah.
I think even the performance there wasn't any shake on the share price as well.
Yeah.
I think that just the interesting thing is just things that are coming up. They both have a June year end,
Yes.
which means that it's that time when they actually report on what's happened and whether or not they're making good money for shareholders and they're beating market consensus, because that's another thing that is a catalyst for a increase on the share price, right? If the market expects that they're going to make an earning of 7 Rand per share and they make 5 Rand per share, the market punish them for that.
They're going to get nailed.
Yeah. But if they exceed that expectation, then you're going to see a lot of green on the screen.
I like that. Green on the screen.
That's kind of how this works. And
green on the screen.
And also just from a strategy perspective, if in terms of growth and all those things, how management are thinking when they do the report season, if that is sufficient and kind of makes sense to the public and investors, then that also can serve as a catalyst for increasing the share price.
Fantastic.
But we'll see, man. We'll see.
No, absolutely fantastic. I wanted to get into a little bit about Shoprite because before this episode, we spoke a little bit. I get schooled by this guy because he's very much a Shoprite person. Everything that you need to know about how Shoprite functions, you have to ask him.
I promise. Shoprite is not paying my salary. Shoprite is not sponsoring this video.
They should, though.
Just to clarify. Yeah.
But anyway, we spoke a little bit about Shoprite in Africa.
Yeah.
And I was convinced that Shoprite was finding so much joy in Africa, but clearly not. And they were not for a very long time.
Yeah.
I read Whitey Basson's biography, of which I learned a little bit more about the soul of Shoprite, having the heart of a grocer, technology in Africa. They've had a bad time in Africa. Can you just speak a little bit about that?
Yeah, so when Shoprite came with the strategy of expanding to the rest of Africa, it was the biggest portion of growth that was going to come out of Shoprite, right? They had this plan that they're going to roll out stores in Africa, West Africa, etc., and grow. And but what they didn't realize was that the cards are dealt a little bit different in the rest of Africa.
Yeah.
The market is not as formalized as South African market. Not to say that South Africa is the gold, none whatsoever, but the dynamics of the rest of Africa, for instance, in West Africa, it's a hustle and bustle environment, right? So to try and formalize that environment and that market, it becomes a little bit difficult, right? Yeah. So you've got a lot of street vendors that Shoprite was competing with, and those guys don't pay tax, for number one. So it becomes a difficult thing when you're a corporate and you formalize and you're competing with those guys that actually don't pay tax, right? And also in the street, price is negotiable, right? And it's a direct substitute of what Shoprite is selling, right? So it becomes a very difficult thing to actually make money out of that. So they actually backtracked on that. They said, we're not making money out of Africa, and they actually reduced Africa presence significantly.
Yeah.
Like properly significantly. And they've got very few stores in Africa now, which they've managed to kind of make money out of them, etc. And what they realized was that the African operations were making losses. It was literally a loss-making business in Shoprite.
Yeah.
And what they did was they realized that the South African or Southern Africa region was actually using the profits to fund the growth in Africa.
And you can't have that, hey?
And yeah, exactly. That business in Africa needed to be independent and break even and actually self-sustaining. But that was not happening for a very long time. And that's when they realized, you know what, it's time to cut our losses. And I think for me, that is a defining moment for management to say, we thought something is going to happen, but it's not happening. We're taking the L, and then we're coming back and going back to the drawing board. That for me works. If you're going to have a management team that is going to realize their mistakes, then you've got people that actually care about the business. But if you've got people that just like, it's my strategy, all those things, then you're going to get banned. Then the next thing, people are going to be doing scandals around, falsify accounts and all of those things, you see.
I think you mentioned something very, very important in the importance of management to pivot from a direction of which it was not profitable. Clearly, it was not working. And for them to actually come out to the market and say that, no, this is a mistake. We accept our L. Let us backtrack on that. And I think that speaks to the brilliance and the competence and the integrity of the Shoprite management team. Again, they're not sponsoring this, but it's just we celebrate excellence.
Exactly.
As much as how we are investors as well, because this is a South African business that employs South Africans and pays South African tax. It's fantastic, bro, and I'm actually quite jealous as to why I don't have them on my portfolio. But
Exactly.
man.
But nonetheless, I think it's let's talk about what you're thinking. Managing a portfolio, it's all about buying and selling and holding, etc. So are you actually thinking about selling? Are you actually thinking about buying some more? What are your thoughts on that?
So yes, I am thinking about buying. The last episode, I mentioned that I will reveal in today's episode what is on my wish list. And on my wish list is Richemont. It is the luxury goods company with a strong South African basis, but most of their operations is handled overseas in Europe, in Switzerland. That's where their headquarters are. And as far as primary listing, I also think it's also on the stock exchange there, and the secondary listing is in Johannesburg. But I speak under heavy correction when it comes to that. So please let me know. Put it down there in the comments and tell me, like, Nico, you're wrong. But that's a company I'm actually looking at the moment. And I'll show you the share price. The share price will come up here so that you can see where it is. At the moment, Richemont, before I get into exactly what they do and what they own, Richemont is trading at about 2,800 Rand a share. Now, what makes this, and this is going to be quite dramatic. I know people are going to get excited when they see this picture because only a few months ago, this company was trading at about 200 Rand a share. Now it's at about 2,000 Rand a share.
Wow.
Okay. What has happened? A couple of things have happened, but like that's dramatic. In fact, I can't think of any other business in the whole of the JSE which has an uptick of about 1,000%. I can't think of one. So a couple of things have happened. Number one, the biggest thing that has happened is what happened in Asia, particularly China, when they eased their COVID restrictions. Now, as far as what Richemont does, Richemont owns luxury goods. So jewelry, the finest jewelry in the world. When it comes to watches, which I'm a big fan of watches, I'm a watch head, they own brands such as A. Lange & Söhne, Cartier, Panerai, so on and so forth. They own those companies and they've gone big into watchmaking. In fact, the biggest watchmaker, luxury watchmaker, one of the high-end luxury makers is definitely Richemont. Very different from the competitors of LVMH, of which I know many people make use of their products, Dior, as well as Hermes. Richemont is about the fourth biggest luxury goods company in the world. Now, China is a huge market, not just for luxury goods, but for almost every single company, but more so for luxury goods. And given that economic shift that has happened in China, where we're seeing a lot more people that are getting into business, achieving greatness and prosperity and wealth, and getting rich, and going and purchasing these watches and these leathers and these, that's when you see luxury companies such as Richemont have done very, very well. And obviously in the easing of the COVID restrictions, that has only pushed this share price on. I think continue going forward. The reason why I'm going to purchase this is because luxury goods, in fact, the question I'm asking myself is, how do luxury goods do in a high inflation, high interest rate environment? There's a school of thought that even says that this type of assets are actually a good hedge against that. So those are some of the questions.
I think I can agree. It kind of makes sense. It's because of the customer base, right? I mean, whether or not the goods is going to increase by 10% or 8%, as a millionaire,
doesn't really
matter.
Yeah, it doesn't really matter.
I'm gonna buy. If I want a Rolex, I'm gonna buy a Rolex. If I want a Switch
Cartier,
watch,
yeah.
a Cartier, a Tiffany,
Yes.
whatsoever,
Yeah.
I'm definitely gonna buy. So it really doesn't matter. In
Another
that
thing
sense.
as well, which I'm just thinking about right now, is because the functional currency is in Swiss francs. And a lot of these watches that they have, in itself, it's a rand hedge.
Yeah.
So, for example, whatever happens in the South African economy, you've got sort of like an inverse occurrence that's happening in, for example, a euro. It's a fantastic way to hedge yourself against the South African rand, the currency movements, the economic movements. We had, I forget the chap's name, but during our reel, he asked us about our internationalizing our portfolio. So this is your answer. This is me going international, and I'm going to do it through Richemont, and that's my first.
You're a big fan of Mr. Rupert, then.
Can we not get into that? Because like I know people are going to have me.
Listening to you, I'm just like, look, this man is literally just going to invest in this guy like all the time.
It's not a bad thing. Like I remember I spoke about it once to a group of investors, in that finding yourself in a space of other successful people is not a bad thing.
Agreed.
If you see that a person is doing well, you'd like to be around that ecosystem. And I think that's an okay thing. It's not an investment philosophy, but having it as a consideration is not bad. Like, for example, that's why I'm so drawn to you. You know, I like people that are doing good things.
But I do not have the billions like Mr. Johan Rupert.
Yeah, whatever.
I'm not there yet, but I will get there soon.
Whatever. Yours, anything on your buy list?
Look, I think for me, what's next is probably going to be BAT. I've been monitoring BAT.
BAT?
That's the British American Tobacco. I've been monitoring that for quite some time now.
Okay.
So I think, one, the tobacco industry, it's a very demand inelastic kind of industry. I mean, people are always going to be smoking.
Demand inelastic. Can you just, it's an economic term. Can you just explain what does inelastic mean, or elasticity?
It doesn't really vary with the changes in prices.
Okay.
Right. That's kind of like the summary explanation. I know the economists are going to have my neck, but that's pretty much it. Right. It's not really affected by the demand of the product is not really affected by the changes in the prices. Right. So for me, what I think about it is people are always going to be buying and smoking. It's just like alcohol, right?
Yeah.
People are going to be drinking always. I believe so.
Always. They have been, they will continue.
Exactly. It's a generational after generation after generation thing. So I believe that that's going to be. And also the toughest thing about it is the regulation, right? There's been a lot of promotion in terms of people must stop smoking and all those things. But what I've seen in the market is that all these companies like Philip Morris and the likes are really reinventing themselves and coming with different, what they call GNPs. Is it NGPs actually? NGPs. New next generation products. So the next generation products is like your vaping and all those different things and whatever that thing they call it. So all those different products are kind of like apparently environmental friendly, all those things. So these companies are not actually sitting back and saying, you know what, people are always going to have a cigarette, but they're saying, how can we reinvent ourselves to actually be in line with the new regulation that is coming in and the promotion of have ESG aspects in terms of the companies itself. So that for me, it's something that that I've seen coming up. And Philip Morris right now, their revenue segmentation, 22% of it comes from the NGPs.
The next generation products.
Exactly. BAT is still a little bit lagging behind with, I think, about 10% or so. So you can imagine that the market is already thinking ahead to say, look, let's reinvent ourselves, let's do all those things. But I'll see. But I think I've been monitoring it for quite a bit, and whenever the opportunity comes in terms of value, when I can enter in, they've been kind of trading at a low multiple, which is like from a PE perspective, they've been trading from a low.
There's
multiple.
that word again, PE multiple.
It's on episode 3 and 2, So they've been trading on low PE multiple as well. So I'm just kind of seeing what's going to be happening, and then
you didn't mention something.
Put a thing on it. Yeah,
you didn't mention something. That also used to be a Rupert company.
Yeah.
In fact, I think it's about 2%, 2, 3, or 4% of the stake in British and American Tobacco is owned by Richemont. Richemont is controlled by the Rupert family.
So is this you where you say you got me?
No, I'm just saying. I mean, like,
this man is just like, you are a fan of Rupert as well.
You dish it out. You better make sure you take it as well.
I can take it. I can take it.
Yeah.
But also, it's for me. It's also. Bet is something that I can understand, right?
Yeah.
It's a fairly stable business. I mean, there's no complication around it, right? Yeah. And also, I'm not just looking at bets. I'm also looking at Philip Morris, which majority of its...
Philip Morris, is it listed in the JC?
Not as much as I know. I think I don't know if they have.
I don't remember. Please let us know. Please let us know. Philip Morris.
Yeah, but it's kind of those things that I'm looking at competitors as well to kind of see how they're doing, etc. So yeah, we'll see when I can pull the trigger on it.
I see. So next week, next episode, we could be dealing with a portfolio that has 6 assets.
Yeah. Maybe when we're on that, I just wanted to kind of ask you a question.
Sure.
Fund managers, when they're managing people's money, right? Yeah. They have a benchmark to kind of bet themselves against, right? Yeah. To say we want to beat inflation plus 2%, or I'm sure a lot of people that have unit trust, they've seen this, right? That our benchmark is a Swiss cap, or our benchmark is inflation plus 2%, whatever, right? Mm-hmm. So do you think we should have our own benchmark?
Let's do it, because I think with these benchmarks, I mean, even the word benchmark, the first time I heard the word benchmark, I thought it was cool. I didn't understand it, and I used it in the wrong context. Yeah. But basically, a benchmark is a standard. So basically, you're asking, should we have a standard? And the answer is yes, we should have a standard. Not only are we competing against ourselves, because we are investing, we're competing against the market. So to actually make it a fairer game, let's compete against each other, but let's compete against the market.
Okay.
Let's definitely have a benchmark.
Fair enough. Yeah. Fair enough. I think it's going to be a good idea to kind of put a benchmark. And this is what people are going to get in the market if they get their money managed by somebody else, like on a unit trust, etc. And it will be kind of good to actually explain as well what happens. And the big question really is around fees, right? Yeah. So what happens when a manager didn't meet the target, or didn't beat the target of, say, all share index, right? Because usually the growth, all those things. So what happens, and firstly, let's kind of discuss the types of fees that you find in with fund managers.
Yeah, so basically this is now, we've actually transitioned into not just you yourself actually investing in individual shares of companies. So this is basically in the context of you investing in a fund, a Coronation, an Ellen Gray, that type of thing. And you started off with benchmarks. That's a very, very important thing. And I think it's also important. Let's warn our investors in that there must be some sort of a benchmark, especially before you get into this fund. Whatever fund it is, usually it does come when it's a properly run fund. There must be a benchmark. Yeah. And for me, the first benchmark that anything that I put my money into, it must be inflation. We're not having a conversation if we're not talking about inflation. I'm so sorry. I mean, literally, if we're not beating inflation, or rather if inflation is the benchmark and we're not meeting that, then by definition, we are getting poorer. Or rather, our money, our investment that's working is getting nailed. once we get over that first hurdle of inflation, that's when now we're starting to talk, okay, how good is the performance? But then, yes, benchmark. Let's also talk about fees, which I would also like your opinion on the fees. We actually had a debate about this.
Exactly.
And it was a fantastic debate. Hopefully we can replicate it now with the fees. So there are two things, particularly if a fund is listed. There's another thing as well. It's another dynamic.
Yeah.
So management fees, regardless of how the fund performs, just by virtue of this manager managing your funds, there is a fee. Now, you might feel a little bit uncomfortable. You're right to feel that way because I also do. But management fees, man, that's one. I would like to get your opinion on management fees. And then obviously number two, performance-based fees. Right? Performance-based fees, number three, and how it all fits into revenue.
Yeah.
Go for it.
Yeah, look, he's trying to replicate a very interesting debate.
It's very interesting. It's even spicy. I would even say it's even spicy. And I'm sure like our LinkedIn followers here, our LinkedIn investors, sorry. I think they're going to find this one quite interesting. So management fees versus performance fees.
Yeah.
How do you feel?
So, I mean, look, I think already for me, I'm comfortable paying management fees, right? I know a portion of my
boring.
I know a portion of my money by virtue of you being a fund manager who has 15 years, 20 years of experience.
Yeah.
I'm paying you for your time to manage my money.
Yeah.
Right? That for me, I'm comfortable with, right? To say, if I'm giving you money and you're going to manage my money, I know at least you've done it before. You've got a track record. If I'm investing on a coronation fund, right? That fund typically has a history of performance, and typically why I'm choosing that fund because I've seen the manager of the fund achieving some success in the past, and therefore I'm saying I can pay to partake on that success, right? That's the management fees. Right? I'm myself, Chipiwa. I'm comfortable paying management fees if I know I'm going to get value for money. Right?
This guy.
Yeah. So from a performance fees perspective, right? That becomes a little bit, iffy. Because, I think what I've seen, especially I was actually watching a podcast today. I do watch other podcasts. I was watching a podcast today, and this guy was just contrasting the performance fees in South Africa versus performance fees in the UK market. Right? And the overall message was that in the UK, you can't really charge performance fees to retail investors. So retail investors could be us, individuals, and all of those things. Right? But in South Africa, whether or not the fund is actually beating the benchmark, you find performance fees in there slotted in for some reason.
What does that mean?
Means that you're getting charged performance fees even though the fund did not perform or beat the benchmark. If you have a benchmark of, say, all share index, and then all share index performs at 7%, and then your fund performs at 6%. For some reason, there's still a bit of a performance fees that gets charged. I'm like,
how does that work?
I know, like, I'm just like, I'm not reading enough into those things. Like, I'm coming in with just the assumption to say, this is how I understand performance fees, whereas they define performance fees differently to what it actually does, right?
That's not right.
So no. Yeah, it's really not. It's really not right. That guy was actually showing the different companies, 91, Coronation, all those different things. Right there. That this is the statement. This is what they're saying the performance fees are. This is what the fund did in the past 3 years. Because fund actually show past 3 years performance, past 2 years, past 5 years.
Past 5 years, past 10 years.
And past 10 years and past 12 months, right? So he's like, yeah, this is what happens in the past 12 months. They didn't beat the benchmark. Whereas, and here's performance fees. I'm like, that doesn't make sense. Because how we understand performance fees is if you beat inflation, and your inflation is your benchmark, right? Say inflation was at 5% and you're at 6%.
Yeah.
That beat, that 1%.
That 1%
is
you can
the
share.
one that we're going to share.
Exactly.
Right? And typically it's like 80-20, right?
Yes.
I get the 80% of the benefits because I provided the capital.
100%.
And then you get the 20% of it for just being a good manager.
Yes.
And getting me the profits.
Yes.
However, that's not what we're seeing in the market.
Okay, mate. I think this segment is gonna go viral. I really, really do. And if a couple of people are gonna come after us, I mean, like, explain to us why are you earning performance fees if you're not performing?
Exactly.
I mean, like, really, I've had plenty of people who come to me and say that I've invested into this fund for about 5 years. And the return hasn't been good. And if you look at it, like, the return was probably good, but it was eaten away by non-existent performance fees and management fees. No, this must change. Like, I think
it's very unfortunate. But also, I think, but the fees, right? Don't charge me exorbitant fees. Don't increase your fees if you're not performing.
Yeah.
I think that's where I'm uncomfortable with. If you're charging, say, 0.5% of the AUM, asset under management, and you every single year you want to increase those fees by 5% of inflation, but you're not growing my money by inflation.
Oh my
then
God.
It doesn't make sense.
No, then
it doesn't make sense.
We're being taken to the cleaners. Then
exactly, it doesn't make sense. I'm actually funding your lifestyle right now.
These fund managers, I always make an example of these fund managers that stay in Camps Bay and drive a Porsche and have fancy socks. Now, mate, I'm glad you actually brought this up because it's very important for our investors, people who follow the Investment Candle podcast, to be aware of these kind of fee structures. Look into the finer detail. In fact, let me not even answer that. What would you say to an investor says, hey, Chifiwa, how do I guard against that type of thing?
Like, first and foremost, I think people just get excited about putting their money. I was that person. I'm just like, okay, let me look at what the fund has done and all those things, right? And then I'm like, okay, cool, I can buy into this.
Yeah.
But looking into reading and actually having understanding of the fee structure that those guys are going to charge you, it's very much important, especially if you parting ways with significant amount of money. What significant is, it's all up to you.
It's up to you. It's relative.
Whether 500 Rand is significant to you, or I know unit trust have a minimum of 500 Rand deposit, debit order, etc. So if that's significant to you, but at the end of the day, it's your money, man. It's your hand-earned cash. So it's important to kind of do proper due diligence in terms of who you're giving your money to and how they're going to charge you for actually handling your money. So, and look, if you don't understand the legal and finance jargons, just ask someone. Like, send Nico and I a DM if possible.
Not late at night, please.
And reach out to all our platforms, and we can kind of help where we can to say, okay, when this fee structure is like this, then it means that you're going to be charged when this circumstances happen, when this doesn't happen, and you can always query if you don't feel comfortable around 100%. Those fees. So I think that for me, I'm very uncomfortable with management fees that increase every single year, but I'm not seeing that increase coming through to my portfolio.
This is
because
fantastic.
it eats your money.
Mate, you have assisted a lot of people. Like when we started the Investment Candle podcast, I always knew it was important. But I think after today's discussion, particularly about management fees, I think it's a must. I think any investor should be listening to this podcast. Yeah. Cool, man.
Cool. So I think kind of the next thing that I wanted to talk about is this guy. I don't know if he spoke to God before he actually went to that Instagram live. So what he did was he predicted that the MPC is going to either pause or increase by 25 basis points, which means he was able to hedge, right? So let's just touch on that. What does it mean if there's an increase in interest rate. How does it affect the portfolio? What is your thoughts on that? But first and foremost, are you a prophet, man?
No. No, I am not a prophet. I'm just I'm a good investor. I think.
From a reel, when we discussed that there was a little bit of a thought process that you applied your mind to it. Maybe it might be good to kind of delve into that too.
Okay, cool. Yeah. So this is a framework which I kind of developed for myself back in varsity when I was in res, and I was just trying to understand how the economy works, how does monetary policy works. I knew that it was important, but I just didn't understand how exactly. But it was nice. Back then, the governor of the Reserve Bank was Jill Marcus. And she would stand up and she will tell us exactly why they've increased or they've decreased or they could have paused. Yes, Chifi was right. Yesterday, it was yesterday, the Monetary Policy Committee came out. Governor Lesitja Kganyago said that they have paused the interest rate hike. Let the entire South Africa say amen. So how does that affect us on the ground, and most importantly, how does that affect our portfolio? The portfolio is a little bit more complex. The regular person on the street is a little bit more straightforward. But we can't speak about the real terms or what's the conditions on the ground and how it affects us without speaking about the transmission mechanism, the monetary policy transmission mechanism. And depending on how it works, on how the transmission mechanism works, the faster the decision up there taken will filter down. And that's in essence what you want in the market. You want efficient markets. You want stuff to filter down fast. At the moment, currently, if I remember correctly, it's roughly about 18 months or so. Yeah, it's about a month and a half for it to filter down, unless if you have a financial instrument of which the interest rate conditions are directly linked to repo. So if anything is directly linked to repo, then instantly it filters down. There's no transmission mechanism, it's instant. However, if you have an indirect financial instrument that is not linked to a repo, so whatever contract that you have, of which the payment terms, the interest terms, it does not say repo, then it will take some time for the repo rate decision to filter down. So whether it's a car loan or whether it's a bond, depending on the conditions of that, that's when it actually affects. Whether it's a credit card, looking at the conditions, that's how it affects the normal person on the street.
Yeah.
Now,
so, a question, right? So how does this affect the customer base of the companies that you invested in?
Yeah.
So, for instance, from a Naspers perspective, how does that filter down to the Naspers consumer, and how does that filter down to a Capitec end consumer?
Okay,
or even just the business themselves.
So yes, so this is you're indirectly saying how does it affect my investment portfolio?
Exactly.
That's a good question, and I think I would like to speak about the Capitec more because I've spoken about Naspers at length.
Okay.
So with Capitec, it's actually even an easier one because Capitec in itself is a bank, right? And ideally, a bank's business is to take deposits and issue out loans. Both of those two functions, the interest rates are a key component to it. Taking in a deposit, they promise you back interest. Issuing out a loan, you are promising to pay back interest. So interest is fundamentally very, very important. Now, how it affects a person, an account holder, a depositor, not just a depositor, but a person who also is taking out a loan in a Capitec, it will affect how much you have to pay on a monthly basis if you've taken out a loan in, let's say, a Capitec. But also, if you are a depositor and you have a fixed account in Capitec, then it will also affect, depending on the conditions of the fixed or even a current, it will affect how much interest you earn. So it affects how much interest you pay as well as how much interest you earn. That's fundamentally how it works on the customer side. But we can go a little bit higher. How does it affect the bank itself, the rates? So the most easiest one is that the bank in itself, because because the bank occurs liabilities in itself, that on the balance sheet, that liabilities is heavily affected by how much interest it's going to pay back. So you mentioned an example in our reel, which you should check it out. In that, instead of, let's say for example, there was a very, very good year. Profits are high. Operationally, things are going well. Instead of a bank distributing dividends, that cash, that money now has to go and actually servicing their debts. Should the interest rate go up, because even their own debts within their books, they're going to have to service that as well. So that's just the long and short of how it affects someone such as Capitec. But I know, and that's a bank, and that's a financial institution. With you have a retailer. I would like to ask you, how does it? Same question, but on a retail level.
Yeah. So from a retail perspective, on Shoprite, being the best performing stock that we hold.
Yes, it's the best.
So it's directly linked, right? So typically a lot of customers that first and foremost, Shoprite has two separate customer base.
Okay.
So the Checkers brand caters for the higher end market, right?
Yeah.
And then you've got the USave, the Shoprite brand, and all of that. So they cater for the lower to middle class, right?
Yeah.
So from a lower to middle class, there's a lot of people that have loans because they try to service their lives, right? Most of people have credit cards from the middle class because sometimes they can't afford things, or they actually buy cars on a debt, right? So they have cars that they're repaying. They have, a bond that they're repaying and all those things, right? So what happens is if there's an uptick of interest, right? It means that their repayments of cars, their repayments of bond whatsoever is going to increase. So that eats into their disposable income, right? So that could really be the difference between buying a Shoprite branded product versus buying a milk that is from Ultramel or it's from what, right? And that kind of affects the margins as well. Right? So the product mix obviously affects the Shoprite margins. That's like on a smaller scale, but obviously it does go into the much larger scale as well, right? Or abandoning some of the items as well. Because I mean, if there is if my bond and my car go up at the same time, it means that maybe I'm parting ways with 500 to 1,000 Rand more than I used to in the previous month. So what does that mean? It means I'm not going to eat cheesecake anymore. I'm going to have Black Forest. I'm going to have Black Forest from Shoprite. So it's that kind of thing that affects. And obviously, a cheesecake is going to have higher margin compared to a Black Forest, right? So that kind of reduce the margins from Shoprite's perspective, and that affects the profits, and that affects ultimately the dividends that could come to me. And when the earnings become lower, means that the investors' sentiment will be like, okay, should we be worried about Shoprite? And then that reflects on the share price itself. So that's kind of my thought process on what interest rate does to kind of the Shoprite thing.
Let's take off our economist and our analyst cap off. Let's take that off. Let's put on our investor cap on. How has Shoprite positioned itself to guard against all of that you just mentioned? Because I mean, these are all stuff that affects everybody. The same issues that affect Shoprite affect Pick and Pay, affect Woolies. How have you positioned yourself in the form of Shoprite to actually guard against this?
So I think in terms of better positioning, right? I think Shoprite has positioned itself very well because one, they've got a very diversified customer base. Like I said, number one, they've got a higher end customer base, which is captured by the Checkers brand. And they've got a lower to middle class that is captured by
Shoprite and you save.
Shoprite, you save, and you're okay.
And correct,
right?
Correct, yeah.
So, and also they've got other products as well, right?
Yes.
So they've got they just recently launched their apparel. I forgot what the name of the store is.
Shoprite launched an apparel.
Yeah, they launched an apparel. I actually, on my birthday, I actually got myself a T-shirt from it.
How's the pricing? Is it something?
It's similar to Pick and Pay clothing.
Okay.
But the quality, in my view, it's much better.
Okay.
The quality is
much better. In your view.
In my view, the quality, I can't remember. It's something IQ something.
Cool.
Yeah.
I'll check it out.
You can see the diversification actually exist within the Shoprite group.
Yeah.
There's other things. They've got baby things as well.
Yes.
That they in the end. Their bigger stores, which is like the Checkers Hyper, offers other products as well that are not just food and groceries and all of those things. So you can see that the diversification is there. But I think in terms of what happens when a consumer is facing pressure from a disposable income, obviously the first thing that consumer cuts is the clothing before food. Right? So, but in terms of the Shoprite, they literally capture them from the lower end all the way to the higher end.
It's true.
So I think that is a very better positioning that they have.
Yeah.
In terms of positioning on the apparel side, I rate Pick and Pay clothing. What they've done with that business is fantastic.
It's awesome.
It's fantastic. Yeah.
Yeah. No, it's awesome. I think that's one thing that I really admire about Shoprite Holdings, in that they've kind of made sure that they had representation up and down the income earning, the value chain, but also in the customer base as to which customer it is, from the high earners to the middle earners to the low earners. They have some sort of representation there, which is fantastic. I think with the Capitec side, because I explained how the rate environment affects Capitec, but I think Capitec as well, the way that they guard against this type of thing, I think it's brilliant. And how you guard against it, you need to watch your loan book like a hawk. Because your loan book, in a time where rates are always increasing, that's when your loan book gets very exposed to the possibility of impairments. So payments, like basically a defaulting. A defaulting of
pretty much the banking crisis that we've seen in the US, right?
Yes.
When the interest rates got a little bit too
recently,
and we saw a lot of banks actually went bankrupt.
It's true.
I forgot the other one that was bought by
Silicon Valley Bank.
Yeah, the Silicon Valley Bank, and then there's another one as well that went.
There was another one but it wasn't just necessarily because of the rate environment. The rate environment didn't help. It was Credit Suisse. Credit Suisse, Silicon Valley Bank. Was there a third one?
No, I think there was two banks from the US. Credit Suisse had their own issues. But there was two banks from the US that had issues when it came to that, because what happens is the banks kind of hold bonds, right?
Yes.
So bonds and interest rate have a very inverse relationship.
Yes,
so what happens is, if interest rates are rising, the bond prices decreases, right? And that kind of affects the assets of the bank itself. And then that's when it becomes risky for the bank to actually be able to guarantee the deposits for their customers.
Yeah. No, fantastic. I think you're right. I just want to go back to
Capitec, yes.
To Capitec. Another thing which made Capitec a really, really. By the way, the name of the bank was First Republic.
Yes.
First Republic. So going back to Capitec, it's the way that they manage their loan book. It's absolutely fantastic, my man. I think as far as them redeeming their loans, or rather managing the paying back of their loans, it's brilliant. Now, there are figures which should be standard across the banking world. I think it's around about 90%. Capitec, last time I checked, it was pushing closer to the 95%. That is when that's when you are telling me, if you're giving me a figure in the 90s, that's when you are telling me that we've got management that actually takes this thing of risk management very, very seriously. And then if you look at the profit and loss statement of Capitec as well, that some of the bank fees, which you might look at it as a good thing or bad thing, but
those 8 rands that people get charged for.
But I mean, like, imagine those, just the banking fees alone, they pay for about 96% of Capitec's overall operational expenses.
That's what we would expect, yeah.
Like, that tells me that you've got management that can control the controllables, and then with the existential stuff, let it happen, because it affects every single person. But then how you look at it, and how you look at your loan book, and how you manage your costs, that's very, very important. And they are still doling out loans, bro. I think it's a nice thing. I know I asked you to put an investor cap on. I'm just taking it off a little bit. I mean, it's very, very important that banks lend. That is your role in society. For me, I will never buy shares in a bank that does not lend, because you're going to end up with the Silicon Valley Bank. Pass on the liability, but at the same time, you're also empowering people. So with the existential stuff such as interest rates, which are informed by inflation, I think Capitec has been stellar. I think they've had a stellar performance, and that's why Capitec will definitely stay in my portfolio. Yeah.
Okay. No, that makes sense. I think just to kind of wrap it up, the portfolio is doing good. I'm still doing all the heavy lifting.
Richemont is coming, Mama. Richemont is coming.
What's happening is that we thinking of adding some more companies into the portfolio.
Yeah.
And so far, Nico is looking at Richemont, which is the luxury goods. I don't know whether he possesses a Richemont thing, because he told us about having a bank account with Capitec. We don't know if he has a luxury watch.
I need to be careful. I need to be careful here. I need to be careful here. And then, I like the company. Let's just say that.
And then I don't smoke, but but I am looking at bets.
British American Tobacco.
Yeah, and see when I can pull the trigger on that. But other than that, good chat always, mate.
As always.
Very good chat. And thank you to our investors. I don't know if you have any last words from your side.
I do. I think this, out of all the episodes, I think this, and probably episode 3 and this one here has been the most technical. And some people have been telling me that. So please continue telling us, what would you like us to break down? Things like monetary policy, transmission mechanism. We can break that stuff down. Impairments, PE ratios. We can definitely break that stuff down. Help us. Let us know. We want to grow together. We want to do great things together. And subscribe to our channel, please. Yes.
All right. Like, comment, and subscribe. That's it from me and Nico.